Hi, I'm Ashish, Head Investments at Motilal Oswal Wealth Management. I'm happy to take you through the key highlights of the May version of our monthly research publication Alpha Strategist. Globally, we see that US is leading the charge in economic recovery, and as a result, we've seen even bond yields in US hardening to about close to 3%. Now, this is also going to generate tailwinds for rest of the world, and we see growth picking up in India as well. From a domestic point of view, we believe we are at a little bit of a crossroads. Why crossroads? Because on one hand, we see that the economic recovery is getting stronger. A lot of the high frequency data like sales of commercial vehicles, sales of auto products, consumer sales in rural areas, etc. has been very strong, and we see this accelerating. Coupled with this, we've also seen a recovery in commodities, especially metals as well as other soft commodities. We believe that this will lead to a good recovery in earnings over the next couple of years. We basically believe at 18 to 20% kind of an earnings recovery is on track. However, at the same time, valuations are slightly stretched, and given the headwinds in the near term in terms of general elections as well as several state elections, we believe markets are expected to be a little volatile and range bound. So we advise equity investors to build their equity positions in a staggered manner, and whenever you get opportunities of 5 to 10% correction, please ensure that you complete your equity allocations. The bond markets have seen a lot of volatility, and there are 2-3 reasons why this volatility has occurred. One, we've seen an increase in state government borrowings. At the same time, we've seen lack of participation, especially from PSU banks, given the recent controversies surrounding some of the banks. However, the government has done its best to ease pressure by allowing FPI participation in bonds below 3 years, as well as RBI recently announcing open market operations. We believe that going forward, rates will be where they are for quite a long time. There may be a case to increase rates maybe in the next 6 to 12 months if our economic recovery gets stronger. So we advise investors to stay in funds which have low maturities like short-term funds or fixed maturity plans, because the absolute yields on AAA bonds, AA bonds are very attractive. So essentially keep it simple in fixed income. Invest in 2 to 3 year maturity funds because the yields are quite attractive at this point in time. Thank you very much.